attending today. It's a great day here in Boca Raton, Florida. That's where we are presenting it from. Um, Welcome wherever you are. Today, we are going to be talking about some financial planning issues that are going to be particularly important for each and every one of us next year. That's 2025. The essence of planning is really an understanding of what's coming down the pike. And then our job is to communicate that to you in very simple language so you understand and you benefit from it by reacting to some of the steps that you'll be taking. At least you need to know what may be important issues for you, because oftentimes these are overlooked. So let's get right into it. We're going to start from where it all started, which was in December of 2017, when the Tax Cuts and Jobs Act was passed by the former president, Donald Trump. And amongst other things, this was one of the most extensive tax reforms in the history of the nation. The only one that compared to this in magnitude was the one that was done by President Ronald Reagan in the 1980s. So this was very significant. We're not going to talk about all of that, but one of the things that is part and parcel of the Tax Cuts and Jobs Act is the estate tax exemptions were doubled. So, okay, right to start with, from $5.49 million, they have moved up every single year. And at the moment, in 2024, it stands at $13.61 million of estate tax exclusion per US citizen during their lifetime. This is known as the lifetime exemption. So for a couple, the total tax exclusion is $27.22 million. This is something that most of us do not have to worry about. It's way more than what the average American does. If you want to be in the top 1% of net worth in the United States, all you need is about 10 or $11 million. Little over $11 million. That's the going rate today. Okay? And if you have more than $2.5 million, you would be in the top 10% in this nation of net worth. So the bars are fairly low. And so this was a bar that was set really, really high. Now, we're not discussing that today. What we are discussing is that on December 31st, 2025, these very generous limits of estate tax exemption disappeared. And they revert back to the way they used to be back in 2017, okay, which was $5 million, then adjusted for inflation. So what does all of this mean? Why are we even talking about it? Well, let's go to the second step. But as you can see on the screen, what we are discussing today is wealth transfer strategies and some basic estate planning concepts that everybody that's probably attending this presentation should be aware of. And there are some sunsetting or end of some of the laws that were established in 2017 that will be ending on December 31st, 2025, and you do need to react to that. That's the purpose of today's presentation. I'm going to go into some depth with this. I think you'll find it extremely interesting. So let's start with the history of this. How has this increased? Okay, and then we'll get into the wealth transfer and strategic gifting ideas. But so if you look at the chart on the right on the screen, in 2008, the total estate tax exemption per US citizen, lifetime exemption, was $2 million. Basically what most people interpreted this as is that when you die, up to $2 million of your estate would escape federal tax. Okay? Federal tax, federal income tax, and federal estate tax. Anything above that had a very onerous tax liability. So as a couple, it would be 2 plus 2, $4 million. As you can see, as the wealth of the United States has exploded and grown, okay, since the beginning of the millennial, what you have seen is that the $2 million exemption became 3.5 in 2009, and on until you come to 2017, when it was almost 5.5 million. But the very next year, it got doubled. This is the impact of the Tax Cuts and Jobs Act, where the individual lifetime exemption jumped to about 11 million, and that has been indexed up due to inflation, and today it stands at $13.6 million per US citizen. That's the lifetime exemption. So if you add them up for a couple, it's about $27.2 million. A lot of money. Most of us will not have a problem as far as federal tax goes, but you do have to pay about state, estate tax, because different states are at different levels. Not all of them follow the guidelines of the federal government. Okay, so that's something to be discussed down the road, not today. But here's a little insight, an observation that I bring to your attention, is that while it was $5 million pre-2017, okay, and it's going to drop next year to the 5 million and then adjusted for inflation. So the number, as we have computed, turns out to be about $7 million. So what used to be $5 million of exemption in 2017, adjusted for inflation, has now become $7 million. What I want you to observe is the reason the federal government is doing this is because of inflation. Because today's hot news this morning is that the inflation, the CPI report came out a lot hotter than what we had all expected. So the stock market is not doing well today. It's taking a beating because it is disappointed. The bond market is off, stock market is off, everything looks bad today. Why is that? Because it basically seals the fact that the Federal Reserve will not be motivated to cut interest rates either in June and most probably not even in July. That's the leaning right now, okay? And it didn't help when the CEO of JP Morgan Chase came out with a news or an article yesterday. It was in the Wall Street Journal, you can look it up, that he expects that inflation will continue to go up in the US. So that's the reaction of the market today. Forget about that, but what I wanted you to see is that $5 million in 2017 is the same as $7 million in 2020, beginning of 2026. And therein you can see the impact of inflation. You need 40% more money to maintain the purchasing power of your money just from 2017 to 2026, 8 years. Okay? So this is a case where I'm probably jumping around a little bit, but I want to make a point, is that if you leave your money in the thrift savings plan, in the G fund, because you don't know what to do, that is not a good solution. You need to work with some professional that will give you proper guidance. It does not have to be us. There are good professionals everywhere in the country, everywhere. Very qualified professionals, but you need professional guidance. Sitting in the G fund basically allows you to not lose money, but you're losing purchasing power every single year. And therefore, this is not this is a recipe for disaster in retirement, for financial planning. Okay, so let's get back to the topic on hand: wealth transfer and strategic gifting. Well, if you have a lot of money, if you inherited $10–15 million from your parents, it would make sense to use the lifetime exemption, the high numbers of lifetime exemption, to transfer some wealth out of your name into the name of your beneficiaries. In most cases, it's children. Okay, it's easy to do. That is not going to be an issue for most people. But where this becomes a really nice application is when, as we are all facing, most of our children are not doing as well as we are. That's a fact. Our youngsters are not doing well for various reasons. We don't need to get into all that. So as parents, we feel like we need to help them out. And we sometimes say, well, let me at least help you with the down payment of your home, because I know you cannot come up with that, but you can pay the mortgage. Practical application of this. For something like that, let's say you have to put down $200,000 or $300,000. Clearly, that's a lot more than what you can transfer to your children tax-free and avoid gift tax. The limit for gift tax is $18,000 per person this year, 2024. So if it goes above 18,000, let's say you need to put down 200,000, right? Let's say you're buying, for your child, a $500,000 home, 500,000 starter home. Okay, at least 20% down, and maybe some costs for closing costs. So 110,000. That's a lot more than 18. Where will the money come from? You can actually give it to them, and you can use this lifetime exemption to avoid any gift tax. Gift tax and estate taxes are very onerous. They start at 40%. So anything over 18,000, if you do not file it properly with the IRS, is going to be subject to gift tax of over 40%, all the way up to 55%. You don't want that. Okay, so we can, it's very simple. Any professional that knows what they're doing can show you how to use this big lifetime exemption to basically help out kids or help out a cause and not pay any taxes. That's the focus of this. So that's a strategic gifting idea. Now, wealth transfer and a bypass trust or a family trust. What is that? Well, all this is that when, if let's say we have husband and wife, and each one has, let's say, right now, $13.6 million, and let's say husband passes away. So whatever is in husband's name, okay, can be passed into something called a bypass trust. Let's say husband had, $4 million in their name. So 13.6 minus 4, that leaves $9.6 million, okay, left. And basically the bypass trust, what that does is the $4 million that's been moved into a bypass trust in the name of the deceased spouse continues to grow without being taxed anymore. The surviving spouse can tap into it for income purposes, but cannot take the principal. And when the second spouse passes away, then all of the money, the first and the second, okay, are passed on to the children or other beneficiaries, tax-free, up to the lifetime exemption amount. I know it's a mouthful, but these are not simple issues. They may sound simple, they're complex, but they are really, really meaningful. And they do add layers of safety in protecting your wealth, both from federal taxes and from state taxes when you pass away, or when you and your spouse pass away. Really important. All right. Next thing, portability for estate and gift tax. I just finished telling you that if we have 13.6 for husband, 13.6 for wife, and husband only had 4 million of estate, then 13.6 minus 4, 9.6 that's left. That can be ported to the surviving spouse's 13.6, So the surviving spouse now has a lot more. This concept is known as portability of estate and gift tax. Very, very convenient. And one of the reasons why it's very important is because the total amount is going to be dropping drastically at the end of 2025. So it's important that for those families, and there are few and far between, but those families that do have this problem, this is a use it or lose it kind of situation. If you don't use it, by the end of 2025, this provision is gone permanently. And it's not good, it's going to be revised back to a lot less. Okay, so there are cases where there'll be unnecessary estate tax that could be saved. All right, then let me talk to you a little bit about the basics. And the basics for estate planning, this is for everybody. You must have a will. There is absolutely zero excuse for anybody for not having a will. So this document will basically give directions upon your death as to how your assets will be distributed according to your wish. The other thing that you must have these days, because we are living longer, okay, and many of us are having health issues in the last 5 to 10 years of our lives. So there's got to be a very clear health directive that spells out clearly the do's and don'ts for how you ought to be, how you would like to be taken care of, okay, in those years. And that needs to be a legal document, which is called the health directive. Then durable power of attorney, this is set up because let's say you become incapacitated in the last 10 years of your life. But your life goes on and need to be taken care of. You need to assign someone when you're still with a full mental capacity to basically designate someone as someone having durable power of attorney over your health and your finances, so that they'll make the best decisions that are in your best interest. The durable power of attorney does expire when you die. It does not continue. Once you're gone, the durable power of attorney is over. Okay? Even if you have assigned it to someone legally. And the most important thing in this very short and very abridged discussion is establishing a living trust. So a living trust basically allows you to take your assets and put them in the name of a trust with you as the trustee. You have full control over it, but it's not in your estate anymore. But the biggest reason why you must establish a living, or should seriously consider establishing a living trust, is because it avoids probate. The only legal document that avoids probate legally in all 50 states of the United States and the District of Columbia is a living trust. It is also known as a revocable trust. A revocable trust and a living trust are one and the same. And the reason it's a revocable trust is because there are two families of trusts: revocable trust and irrevocable trust. Their applications are very, very different. Each trust inside these two families is designed to solve some specific problems. So a revocable trust basically says that you can change your mind about how you want to distribute your estate until the day you die. Okay? And that's why you see in some movies, when someone is like, on their last days, the children are bringing some, newly designed estate plan and saying, "Would you please sign this?" And the person that's dying doesn't even know what they're doing, and they might sign. If they sign, that's legal. Now, it can be challenged because they might have done this under duress, etc. We don't get into all that. Okay? But the point is that if you establish a living trust when you have full mental capacity, that's a very good thing. It should be thought through, and it can be changed as we go along. Okay. Now, Why is this so important? I'll give you the 5 main reasons why estate planning has become very important in our society, particularly for the audience that I am speaking to today. This is a well-to-do audience, okay? They're not super rich, but they're not poor either. They're very comfortable and they will have some assets that they need to make decisions about when they pass away. The main reasons are right there in the middle of the screen. Divorces. Divorces are a fact of life in the United States. You know, we've got a still about close to 50% rate of divorces in this country. So what happens when you divorce? Well, your beneficiary designations go through a nightmare. Everything changes. Marriages, okay? Marriages in terms of new marriages, you know, second marriages, third marriages, fourth marriages. What does that do? We all have blended families. What does a blended family have? Nothing but headbutting. It's just, you know, maybe the two people at the top married for love, but everybody underneath that, there's a lot of headbutting going on, a lot of, you know, arguments going on. Why did mom have to marry this person? Why did dad have to remarry, etc.? So that creates nightmares inside the beneficiary designations. And oftentimes, one of the things that we see in our practice when we are dealing with complex cases is the beneficiary designations are all messed up. Okay. Third reason, children coming of age. When children become adults, many of the accounts become available to them. We got to be very careful in terms of how to structure them so that they're not spent frivolously, that children don't take the money and blow it on a sports car. New children meaning, you know, when you have a blended family, now all your beneficiary designations are out the window. Okay, you got to redesign it. Grandchildren. Now, when you get new children, new grandchildren, or adopted grandchildren, what does that do? That has to cause the living trust to change. You've got to go back and redo all this, okay? Because these are facts of life. They will happen. And this is one of the most important things that, you know, firms like ours do, which is actually review it and make sure that they're in the right place. Okay, next idea. You know, we talked about use it or lose it. If you do not do something, by the end of 2025, all of this is gone. There'll be new laws. There's going to be a new president. You know, who knows who's going to be the next president? I don't want to think about that because it's just stressful, okay? But what we are absolutely certain about, and this is what the CEO of Chase Bank, JP Morgan Chase, hinted at, you know, front page article in the Wall Street Journal yesterday, is that we must pay attention to our finances and set things up properly, because every government in every nation has been spending money and it's been financed by debt. There will come a point where this could turn into a crisis. This was the essence of Jamie Dimon's article in the Wall Street Journal. And the second thing he mentioned is that, you know, we have positioned JP Morgan Chase so well that we are not going to suffer any losses. So that's a pitch. It's a sales pitch, that if you have Bank of America, Wells Fargo, UBS, you know, etc., dump it and buy JP Morgan Chase. So that's a little slick sales pitch. However, the first point that, you know, interest rates federal funds rate could go as high as 8%, that sent shivers, you know, through Wall Street yesterday. And today, when the CPI numbers did not come out good, they're all higher. Inflation is going back up again, okay? This ties the hands of the Federal Reserve from cutting interest rates, you know, in June and July. And potentially, if things don't improve in the next month or two, then we may not get an interest rate cut this year because the Federal Reserve cannot justify it. That's the problem, okay? So anyway, you got a little bit of a market overview of what's going on. Can we deal with it? Yes, we can. The one thing, you know, otherwise we would not exist. We most definitely, very confidently can deal with this. And this is basically what Jamie Dimon was trying to say, is that there are ways to offset some of these movements, market movements due to adverse economic data. Okay, so what are some of the key reasons that people should establish an estate plan? Okay, or what? How could an estate plan fail? Well, if you don't have an estate plan, then you're probably setting yourself and your family, your beneficiaries and survivors for some disappointment. The second reason estate plans fail is because the beneficiary designations have not been tested and set up according to your wishes. Very important. Then lost documents. Okay, you don't wait to establish an estate plan just before you die. You have to do this well in advance, and you got to every 2 to 3 years revisit and make tweaks to it to reflect exactly where your thinking is today. And oftentimes documents get lost. They can be replaced, but they need time. But you need to first make sure that, whether you have them or not. Outdated documents. This is also very important, such as a will, because what happens is many of the provisions in the tax laws expire. Like the sunset, of the Tax Cuts and Jobs Act at the end of 2025. They expire. So you need to reposition yourself. That's what we're talking about today, is you need to pay attention to this. Okay, not updating powers of attorney. This is very important. If your power, let's say the person that you had assigned the power of attorney to passed away or does not want to do it anymore, wants to get out, you need to update that. You cannot just leave your, estate plan or your living trust alone. Choosing an inappropriate executor. You cannot choose a rogue executor. If you choose someone that's going to sabotage all your plans, that's a bad thing. So you have to be careful in terms of who you designate as the executor of your estate. Really, really important, because they must have your best, interest at heart. Then this is another very common thing: not funding a living trust. So people, and I've seen this so many times in my 31 years of doing this, is that you have spent all the money, you spent your $5,000, you set up your living trust, but did not fund it. In other words, you did not change the titles of the assets, like your home, your rental home, your checking account, your cars, your diamond set, all of that. The titles need to be transferred into the name of the trust. You cannot own that individually, because otherwise that gets subjected to probate. And furthermore, depending on the value, you may owe some taxes. So this has to be cleaned up well before you die. In other words, the sooner the better. So if you're over 50 years of age, you need to pay attention to some of these things. Forgetting about tax implications. Very, very important. And not seeking professional help. Most people have the impression that, this doesn't affect me. And they are wrong. They should consult with a professional, especially a group like this that I'm speaking to today. Okay? All right, so that was a very quick overview of some of the tax law changes that are going to take place at the end of next year. But what we would like to now get into for another 5 or 10 minutes is, what do you do, or how do you get started? Where do you begin? Who's going to help you at least get an idea? So we have designed a program which is free of charge, with no obligations and no strings attached. This is a charity that we do as a firm, okay? And we are happy to do this. We have been doing this for 30 years. So this is not brand new. And we are happy to do this, and we do not expect anybody to do something, to become a client out of this. Just a charity. That's all it is. Pro bono work to help people make informed financial decisions and not speculate, not be scared, not be afraid. We are trying to remove the fear factor around financial planning and financial matters. You do not have to be afraid. It's not complex. And that's what this thing is that we offer. So what is it? Well, we offer as a firm 5 services. The first one is investment management, something called the watchdog service. Okay, the main benefit of this is for you to be able to at least not avoid some of the basic mistakes. In other words, people stay with their $1 million TSP all in the G fund. Why? Because they don't know what to do and they don't know how to change it from month to month, day to day, depending on economic data. This is not hard. And you can get these services probably at very low cost or no cost. And that's what this is. We offer that. Okay? Tax reduction planning. This is perhaps the most overlooked part of managing people's finances. People do not like to do tax planning. There's a ton you can do. And for the crowd that's listening in today to this presentation, at a bare minimum, you will save probably from $250,000 to $1 million of unnecessary taxes during your lifetime and after you pass away. So with proper planning and proper strategy, it is not genius level planning. It's very simple, but you have to put the things in the right buckets. That's tax reduction planning. We can help you with that. Next, retirement income and distribution planning. Once you're in retirement, how do you draw down your resources? Do you take your money from your checking account or from your IRA, from your TSP or your Roth IRA? Which one should be used and for what purpose? Which assets are the best for legacy? All of that will be affected depending on how you draw down your resources in retirement. That's actually any time in your life. Family wealth planning, this is what we were focusing on, giving you some of the basics of estate planning and making you aware of how tax laws change. And I promise you this, without knowing it, that the next administration, whoever it is going to be focusing on a lot of tax reform. It has to happen because of the climbing national debt and because of the maldistribution of wealth in the United States. And this is not, the United States is not alone in this. Just about all growing and advanced countries have this problem. Okay, that there's, as the country grows, there's maldistribution. It's in China, it's in India, it's in Germany, it's in England. You take any country, it's in Japan, okay? There will be a group of haves and a group of have-nots. And the wealth will always be concentrated towards the top. You cannot avoid it. So therefore, the politicians from time to time will step in and try to, even this out a little bit if they can. So that's family wealth planning, that we talked about, and there will be more tax law changes. So then these are the services that we look at and what we do for you to start get started without having to commit to becoming a client or anything like that, and at no charge, is we can actually help you get a sense of where you stand today, what can you expect in retirement, and what are some of the things that you should be thinking about. We do not get into what to buy and what to sell. We do not sell any products or services. This is just conceptual, okay? And if you want us to put together a plan for you that gives you some control over what are the relevant issues that you need to be aware of and focus on, because you're not going to be able to find out everything that took me 31 years of doing this and another 10 years of schooling. So I've been doing this for over 40 years, okay? You're not going to pick that up by just reading the newspaper or the magazines. Not going to happen. So you need to work with some professional. And what we are saying is that we are willing and happy and eager to give you a jump start at no cost, but we need to collect some data from you. Once we collect the data, we produce 2 reports. We give them to you and we spend another 45 minutes, an hour to walk you through that so you understand what are the issues that you ought to be focusing on. And that's the end of it. If you decide to work with us after that, that's entirely up to you. You don't owe us a penny. So what are some of the things that we collect? The financial planning questionnaires that we work with you and actually help you complete. You don't have to do it, but one of our analysts will actually work with you and basically take down the information. But we do need a copy of your most recent tax return, your social security statement. If it's husband and wife, we need both. Your benefit statement, or if you're not if you're not in the federal government, then at least some kind of a pension statement. For the federal government employees, an earnings and leave statement is extremely helpful. It tells us how much you're putting away, how you're building your future. And then any outside held investments and statements, even like owning some homes, rental properties, etc. Copy of your TSP statement and a completed expenses worksheet. This is not required if you already know how much you spend on a monthly basis, but this is a very helpful worksheet that we are happy to send to you that allows you to get a baseline of what you need to be comfortable today. Okay, so once we get all this, you get in touch with Nona Butler in our office. We've got two offices. So the first office is in Washington, D.C., 601 Pennsylvania Avenue Northwest. It looks like, Nona, I'm seeing a note here that some people cannot hear me. So if you can please look into that. I got a note from someone who said they couldn't hear me. They only were able to see my screen. So anyway, coming back to we have two offices, one at 601 Pennsylvania Avenue Northwest. It's in between the Ronald Reagan building and the Capitol Dome. You're always welcome to come there. The second office, which is where I'm doing this presentation from, is in a place in Boca Raton called the Meisner Park at Plaza Real. You're welcome to come here as well, and I can meet people face to face as well in the DC office. We do that. I'm there every other month. And what happens is, if you're interested, you get in touch with Nona, call her at this number let me go back. At 240-720-0084, Nona's extension is 105, or you can send her an email at support@ifind.education. iFind Education is the charitable arm. It is not for profit. It does not have any revenue, but that's our delivery arm for all the pro bono and free work that we do. iFind stands for Informed Financial Decisions and Education. It is dedicated for educating people. So that's why it goes to iFind.education, because we don't expect to make any money out of this. This is just to help out people who may be a little confused or struggling with how to get started. So once you send us the information and we gather some data on you, that's when we can produce the two reports that we send to you, and then we go over them with you. And that's when the aha moments come. Okay, so that's where you can reach us. Now, the other thing I would like to point out is that we have discovered through AFSA and by dealing with foreign service officers and anybody from the State Department, that there is a great deal of interest and acute need for this kind of information all over the globe where the State Department folks serve, the 183 or 186 embassies that we have around the globe. So we want as many people as we possibly can help to benefit from this. So tomorrow, if you attended the presentation today, or if you're going to be watching this, on Saturday, because you'll probably get the link to this recorded presentation, feel free to please distribute it to anybody you want. We do not want this information to be, to be closed up and not shared, because We don't mind helping as many people as we can. Let them have it. And if they would like a free analysis, we are happy to do that for them as well. We've got the setup for doing that, and it does not cost anything. So please try to share this with others who may be interested in doing this. Okay, with that, I would like to say thank you for giving me an opportunity to speak at this gathering. I also wanted to point out that since AFSA is going to be celebrating its 100 years of existence, and there will be a centennial issue of the Foreign Service Journal next month, we want you to look up our advertisement on page 4, next to the menu of the contents. Okay, you will see Washington Retirement Planning Specialist advertisement, and also we are going to have a presentation just like this to celebrate the 100 years of AFSA and the Foreign Service Journal and the State Department. So we will be having a presentation in May. It will be advertised. There will be information in the AFSA Centennial issue of the Foreign Service Journal. I hope you look us up, and that's another way you can get in touch with us. All the information of how to reach us is also presented there. With that, Nona, I would like to turn this back to you and see if we have any questions from anybody.
There are no questions in the chat at this time, GB.
Okay, so then I would like to thank everyone who attended today. I hope you found this informative. Feel free to get in touch with us if you need anything, and have a wonderful day. Thank you very much.